You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on Cyclesman.com. Welcome to the show, Tim.
Hey, Jim. Thanks for having me again.
Well, you've got your charts open, you said. We're going to take a look at commodities and oil prices. Maybe start off with commodities.
Well, you asked me if it was too late, but when we were talking to take advantage of, the move in commodities. And, I guess not. I think they're at a point where there's probably a bounce due, an short to intermediate degree bounce due. But this is a perfect example of people wanting to catch the train after it's left the station. And rather than, and I want to tie this into the current situation with equities to make the point. But, you talk about the statistics with the market, the DNA markers that I talk about and all this kind of thing. There is a very, very, very specific setup with that every market has its own rhythm. It dances to its own beat, and the cycle ebbs and flows, and there's characteristics. And one of the characteristics, and it's 100%er, there's a 3-year cycle in the CRB, which is a basket of commodities. It's an index that's reflective of commodities and simplistically. And going back into the 70s, what I have found is that it's real simple. Anytime that cycle sets up, let's just keep it simple in a left-translated manner, and that's topping left of center, and it tops within so many months. I don't want to give away all the trade secrets. But when it tops within so many months, 100% of the time, it has moved below the previous 3-year cycle low. 100% of the time. And I don't remember how many times that's happened, 6 or 7 or something like that. But since the 70s, that is a trait. Well, the last 3-year cycle low in commodities occurred in June of 12. And we rallied into a high I'm looking at the chart now, in September of 12. And then we kind of drifted lower, but we made a higher low with that next intermediate degree low. And then we rallied again into early this year, and that cycle failed. The market is also about structure. Structure has something to do with those DNA markers. It's like steps. You look at steps and, you have basically higher highs and higher lows. Well, in a downtrend, you have lower highs and lower lows. And it's that transitional shift from right translation to left translation that you look for. Well, when the CRB rallied out of that late 2013 low into the high earlier this year and didn't take out the previous high, you had 2 things happen, or really 3 or 4 things happen. But we had an intermediate degree cycle that peaked in a left translated manner. It failed to move above the previous intermediate degree high, which confirmed the 3-year cycle had peaked within that time frame, which statistically suggested that the market was going to go below the 2012 low, way back earlier this year. I wrote about it in the research letter. And so that was the time, ideally, to capitalize on this knowledge. But what people do is when something is setting up there like that, at that time, let me get the oil chart. At that time when that happened, oil was at, between 100 and 107, 8, $10 a barrel, in that range. Who would have believed that it was going to go to 60? People can't believe it. They can't believe these things. And it's just like, the point is it's just like with the statistics. My point in saying that is that this is real. This is a statistic that just happened. It's in print, in the newsletter, happened this year. And it's 100%er. It's since the 70s. And yet, we have a stock market that is so far outside of the norm. Same sort of situation. People can't see these statistics. They can't see it. They don't want to believe it. They can't believe it. And my point is, I guess, is that these statistics, these DNA markers, these setup, this structure is everything. And the current situation with equities is that, in my view, this is the most dangerous market since the inception of the stock market. And the reason I say that is because we are operating so far outside of the norm, any statistical norm. This is the longest 4-year cycle advance since 1896. And that reversion to the norm, the statistics will snap back. It will come back. They will come back to the norm. And so in those statistics also in the structure and everything, just like with the CRB, tells me that this is an anomaly. It's one hell of an anomaly, but it's an anomaly. And the statistics tell me what the end result will be. But you can sit here and tell people this and tell people this and tell people this, and I've seen it time and time again. It's a cycle itself. When you tell people when oil's at $110 a barrel that it's gonna, that commodities are going to go down, nobody believes it. They can't, because they can't see it. And I guess people can't believe what they can't see. You sit here and tell people this is a bear market rally and how far outside the norm is and how it's going to end, they can't believe it. When the thing collapses 50%, then they go, oh my God, can you help me? Well, it's a little too late. And so that's the point. And this same statistic back to commodities in 2008 was the last time this cycle set up that way. And I remember it peaked in July, as I recall. I'm not looking at that chart right now, but it peaked I think it was July of 2008. My buddy John Grant and I were doing an interview, and I made the call on the air. I said, look, commodities have peaked. And the talk at the time was peak oil, peak oil, peak oil, peak oil. Oil was going to $200+ a barrel. I said, no, commodities have peaked. Crude oil has peaked because of that DNA marker. And I'm not, when you have something that's a 100%er on your side, odds are pretty strong that you're right. So I stuck to the call. And I actually had emails, like I would call them hate emails, people telling me how just blatantly ignorant I was to make such a call. And I guess the point is that I just want people to understand this statistical stuff, it works. And what we're dealing with equities is, a very manipulated, strung out market. I think we may have talked about it in an interview or two ago that I even see it at this point that when the market comes into important technical junctures, it almost looks like the news is engineered to blow out any kind of little setup that tries to happen. So the manipulation is like the deal with the Bank of Japan when they came out with their announcement last month. That was at a very, very critical juncture. I see those things going on, but they're stringing it out. They're kicking the can down the road. And like I said, when the snapback comes and the setup finally happens and it sticks, the reversion to the mean with these statistics, there's going to be hell to pay. And the time to get educated, understand what's going on, is not after the train's left the station, but get on board before it leaves the station and educate yourself so you understand what's happening. That's the best advice I have.
Many of the analysts I've talked to expect a major crash in October, the traditional month for crashes. Is it set up to do that?
No, not right now. I mean, the market was on. I mean, and look, I don't want anybody to misread anything. Like I said, let me try to clarify that. Back in October, yes, the market was on the cliff. It was like standing on the edge of the Grand Canyon. We had a setup, and it was ugly. And anything could have happened. And that's what I'm saying. During that time frame is when the Bank of Japan came out with the announcement at the critical point, when this thing is on the edge, ready to jump, if you will. At that precise moment, they came out and they blew out the setup. And that's what I think. I think that a lot of the manipulation now is just happening through the news. It's just vocal manipulation. And so now, does that mean that the market is not still strung out? Does that negate the statistics? Does that mean that the statistics are no longer valid? Does it change anything really? No. But it does kick the can down the road a little more. So we need another setup. We need to see things develop again. And then when it does, that's another opportunity. It'll be another window of opportunity for a top to evolve and for the thing to happen. And I think that when it does, I think it's going to be just like with crude oil. I think it's going to happen fast. Because once it's out of control and gravity takes over, the statistics will be fulfilled, and I think that it's so far out of kilter, so far out of the norm, however you want to say it, that once the snapback comes, I think it's just going to be brutally fast. And people that don't understand or know what's happened, I think they could get caught in it. And it, I think it could just be. I fear, Jim. I really fear the consequences of the downside once it sets up.
I've heard talk that they say, well, if it looks like that's going to happen, we'll just reintroduce quantitative easing again. Isn't that just throwing good money after bad?
Well, I don't know.
Because it's not going to stop it from happening, is it?
Well, I don't agree with the quantitative easing because it's not a free market. And I used to have a hard time subscribing to the manipulation theories, and that, the very basis or one of the very basics of technical analysis is that, it's all about price and everything's discounted at a price. And that's true. And it really doesn't matter what's driving price. But I think we'd be a fool to deny the manipulation, and obviously quantitative easing is manipulation. But I think what happens is that, yes, quantitative easing and, like I said, playing with news and strategically releasing things and IPOs at certain points, like the Alibaba thing. That's another one. Came out at a very, very, very critical point. Maybe it's coincidence. Maybe it just looks like that. But I've seen a number of those coincidences if that's the case. Those things can only work so long because you have to ask yourself this common sense question. Has there ever been a time in history, ever? I mean, I got charts that go back for, well over 100 years in certain areas, and you see bubbles and parabolic moves, and some of them what the stories are and why they allegedly happened and so forth. But has there ever been a time in history where manipulation worked? Ever? I mean, I encourage anyone, tell me one time. It can work for the short to intermediate term, and maybe the intermediate term in this case, the intermediate term, it is stretched this 4-year cycle to the longest 4-year cycle ever. But there's no time in history ever that a market can be endlessly manipulated. And so my point is that eventually I think we're already seeing that they're getting less bang for the buck. It's taking more and more intervention to hold, more and more and more and more. And it's going to get to the point where it's just not going to work. And if you look at that, if you want evidence of that, look at what happened coming out of the 09 low. This time, all of the intervention, all of the efforts, if you will, went to equities. Did it take commodities to new highs? Did housing recover? Did housing go back to new highs? Did any other asset class go back to new highs? Gold did move to a new high in 2011, but besides that, everything else pretty much has not moved back above the 07, 08 highs whenever they were made. It's been equities. And equities, because equities are up, it's kind of masked what's really going on. And so my point is that by this time it only being, the bubble only being in equities, that's evidence that you can see that there's less bang for the buck.
We'll have more with Tim Cyclesman Wood right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking to Tim Cyclesman Wood. Tim, where are we in the crude oil cycle? Have we hit the bottom on that, or can you say?
Well, yeah, I can talk about it. It's we should be, at an intermediate degree low. And when I say an intermediate degree low, there should be a bounce. And again, have we seen the bottom? I don't think so, because the 3-year cycle bottom is not due yet. And so that's the problem with catching the train after it leaves the station. it's better to catch it once you see the setup if you're going to participate. But right now I see an intermediate degree low. And it depends on how hard the 3-year cycle continues to bear down as to how much bounce you get. I mean, it's like a counter trend move. And that remains to be seen. That's kind of a crystal ball thing there. I don't know how much of an intermediate term bounce we get. Maybe it fails. Maybe it doesn't. Maybe it retraces 50% here. That's a harder call to me than the call with the higher degree cycle. But the short answer is we should be at or near an intermediate degree bounce, and I think it will be a bounce, and then I think lower prices are still out there for commodities before we move into that higher degree 3-year cycle low. I don't know. Does that answer the question?
Well, it sure does.
Well, Jim, the other thing I'd like to add on the equity situation, because I think that's the next bubble to crack. And that is, I don't know how to make anybody believe anything. You can lead a horse to water, but you can't make it drink, sort of thing. But all I know, and I'm working on the letter this week, the December research letter, and I look over this long-term statistics and all this work, and I am convinced, looking at the data beyond any shadow of a doubt, and I know this sounds crazy, but I'm going to say it because you could hold a gun to my head and you would not get a different answer from me. Every indication is that this has been a bear market rally. I realize it's at a new high, but the characteristics of the market are not that of a secular bull market when you look at the underlying volume characteristics and other things. It has managed to move to these levels because of the intervention. And that has not fixed the underlying problem with the economy or really even the market. All it has done is made matters worse, much worse. I said during the advance in 2005 and 6 and 7, as that 4-year cycle just continued to grind higher and higher and higher, said the same thing because of the same reasons. Well, this is the same kind of scenario times 10, I think. I mean, this is the most insane thing, like I said, since the inception of the Dow Jones Industrial Averages in 1896. This is an extreme, and I guess that's the only warning I can say. You sit here at new highs and everybody feels good and they think it's just going to continue higher, and it may continue higher for a while longer. I don't know. We need to set up to cap it. But I just want people to understand the risk in what we're dealing with, and if anyone wants hard research to look at, just like with the CRB, the setup with the CRB, in commodities back in June, July, and August when that developed. If anybody wants that research on equities now before it happens, and to kind of get on board to understand what's going on, that research is available. Take a look at it. At least take a look at it. And like I said, I hate to see people tune into CNBC and the mainstream media, and they're told to crock of lies that everything's fine, the economy's good, we're recovering, and they have some bonehead analyst on that says that the market's going to go to 30,000, and people put their hard-earned money and faith and trust in that, and then they get their butts handed to them with statistically what I think is going to come. And so that's what I'm saying. Just, look at more than TV.
Thanks a lot, Tim, for speaking with us.
You're welcome, Jim.
We've been talking to Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. And as Tim points out, this isn't a newsletter. This is a research letter, right?
Yes, it is, Jim. It absolutely is. It's a teaching research letter. It's not something you pick up, a newsletter you pick up and go, that's interesting, but it's meat and potatoes. It tells you not what's going to happen, or not only what's going to happen and what the expectations are, but why. It's not what time it is, it's how you build the clock. Details.
Tick-tock.
That's it.
Thanks a lot again. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. We've also got a YouTube channel, Talk Digital Network. Comments about the show can be sent to info@howstreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.